I previously did a video on American Tower and how Chuck Ackrey had made over 200 times his investment by buying and holding American Tower. A member of the unrivaled investing community asked me to dive into another competitor, SBA Communications, SBAC is the ticker, that has had a similarly outstanding run over the last 20 years, has generated a 68x return on your funds. Looking at the business, trying to understand what is SBAC or what is SBA Communications, what do they do, what do I think about the stock, how does it compare against American Tower? I'm going to cover all of that in this video. If you enjoy educational investment videos, you're watching Unrivaled Investing, please hit that subscribe button. So understanding SBA Communications, really very similar business model to American Tower, where it's about having the land, and in the case of SBA, they own around 70% of the properties, where they have these towers where mobile carriers can put the towers, the equipment on this, and they lease out the equipment. And the unit economics work that ultimately, for that one property, you don't really generate tremendous returns with one tenant. You want multiple carriers all on the property. And when you get to 2 to 3 carriers all leasing out the same tower, that's when you get an attractive return on invested capital. And American Tower shows the sample tower economics with this slide showing how, one tower can cost, $300,000 between licensing and permitting and building it. And then annual expenses of, let's say, 10 to 20 grand a year, just in terms of operating it, whether or not it's ground rent or property taxes. And you really don't generate a meaningful return on investment with just one tenant. And that's a key important point, because that means it's more attractive to lease this out from the mobile carrier perspective, versus just, hey, we're going to build this ourselves. We're not going to get a tremendous return on investment, versus if you're able to lease it. Whereas when you get 3 carriers all on the same tower, you can actually get very enticing return on the capital deployed. The reason why this is important to understand is from the customer or the carrier perspective. When they're partnering with a tower company like SBA, it means higher return on invested capital, financial efficiency, greater use of their balance sheet, easier access and speed to market, because they don't need to build it themselves. They can look at what's already built there, what are the towers available. And it's also a form of risk mitigation. If they build the towers themselves and something happens to it, that's a problem. Whereas when you're working with SBA, you're renting it from them, and that's part of the agreement. For the tower companies, it means you have a very predictable annual earnings power, annual free cash flow. And we'll talk about the difference between earnings and free cash flow in just a second. And it has a real beauty with annual pricing escalators, meaning the prices get to go a few percent higher every year, tied to inflation, and very limited customer churn. And on this point, management's guiding to 2023 revenue around $2.5 billion in terms of their site leasing revenue. So their leasing revenue. They also have effectively some small revenue, under, let's say, 10% tied to helping build out new sites, and giving guidance on that. But most of their business, the vast majority, 95% plus, is tied to this leasing business, leasing their properties out, leasing these towers. And you look at the churn, and they're saying $85 million in churn on a business doing $2.5 billion. So you're talking about 3% churn, and usually it's due to some sort of M&A activity in an industry. In this case, it's Sprint, I believe. Now, the flip side to this is, even though it creates a win-win for the carriers and for the tower, leasers, the challenge is that you do get some customer concentration, where looking at SBA, they have significant customer concentration, with T-Mobile 40% of their revenue for the domestic sites, AT&T 28%, Verizon Wireless 20%. So you can see the top 3 players represent the vast majority of the revenue. And you can see in their international business, it's also fairly concentrated as well. And the reason why this is important is to understand, if one of these carriers have a problem, then it's your problem. If AT&T or T-Mobile starts losing market share, or there's some sort of challenge, the question is, hey, if they have a problem, will it translate into lower revenues for you? Could it result in maybe a challenge with receivables. And they try to get around this by creating long-term master lease agreements with their customers, typically multi-year, possibly even multi-decade agreements, saying this is what we're going to build out. This is the level of technology that is expected to use. These are the annual escalators. And most recently, they announced a deal with AT&T, but you don't go into the exact details of, what exactly are the unit economics, going to be. Now, you might look at this and say, well, Daniel, SBAC trades at 46 times PE ratio. Doesn't this look crazy expensive? You are getting a 1.5% dividend, but isn't the valuation just bananas? I mean, not that compelling. It's important to understand. Here it is. I'm looking at the financials using AI Ticker Chat. You can see the link below for a free month using AI Ticker Chat, where net income you see here around $460 million in 2022 pales in comparison to their actual free cash flow. They generated operating cash flow of $1.3 billion, where a big difference is depreciation and amortization. So they only spend around $200 million, between $100 and $200 million in terms of maintenance capital expenditures. Some years it might be higher, closer to $300 million. But looking at their capital expenditures, it pales in comparison. It is very significantly discounted relative to what they already have in terms of what they own and what they're depreciating against. And that's the reason why you get a huge discrepancy between what they're actually earning and what their free cash flow is. And that free cash flow has enabled them to spend billions of dollars, and you can see this in acquisitions, on not only their capital expenditures, but also making new purchases. So what are these acquisitions that they're spending, $1 billion plus? Well, you can see over the last few years that it's been primarily international expansion. They bought 1,400 plus sites from Airtel Tanzania. They bought another 2,600 sites in Brazil. So this is all about getting international growth. And so you can look at this free cash flow and think, okay, they're reinvesting in the business to drive growth in the years ahead. And when you think about, data usages and the infrastructure, around the world, this is a multi-year secular tailwind for a tower owner, because the amount of data being demanded from mobile usage is just exploding. So you're going to see more and more need from the carriers to lease these properties. And then when you're talking about 5G, you're going to need even more equipment, more properties. So this is very strong international growth over time, and realistically adjusting this business for this, accounting differential between what they actually spend and the accounting depreciation and amortization means that it's actually really trading closer to 20 times free cash flow. This is a cash cow. I'd say 20 times free cash flow is a much more reasonable valuation for this business. And so it's not 46 times earnings like what you look at. And it's important to recognize this business is valued based on its free cash flow. How much free cash flow can it return to shareholders? So then you look at the stock, it's down around 25% despite a little dividend over the last 3 years. Why has it lost its value? Why is the stock declining when the underlying business seems to be performing very well? First of all, full disclosure, this is not financial advice. Also, a quick plug, at Unrivaled Investing, my goal is to help everyday investors by identifying companies with compelling long-term business prospects, attractive valuations, and aligned management teams. I'm looking for companies that I can partner with and hold for years with the prospect of hundreds of % upside. I share my investment journey in a weekly letter at unrivaledinvesting.com if you'd like to learn more. A lot of people, call out my videos here and they say, Daniel, you're so picky. And I think part of it is just because a lot of the investment game is saying no to things and, figuring out what type of investment journey you want to have. And so I cover a lot of companies that people ask me to look at, and I'll say, hey, here are the reasons why I'm not necessarily interested in it. For example, in this company, looking at SBA, they don't really have a founder-led business. You have a, hired gun CEO who's been with the business for a little while, but I'd much rather have that founder with a clear mission of, what's going to drive it. That's personal. I sleep better when the founder's running it. So I think the key risk to think about is the fact that cash has moved up so significantly over, the rate of interest on cash has moved up so significantly. Now it's around 5%. You can get 4.8% plus at Interactive Brokers. So if you can get around 5% on cash, U.S. Treasury bonds, Treasury bills, what should corporate bonds yield? That is the trillion-dollar question impacting a lot of companies. And I think that's the main reason why SBA has come under pressure, because let's look at their debt. Management calls out how they have a leverage ratio of 6.6 times. That is a lot of debt. 6.6 times. Now they can do that. Now that's talking about total debt to EBITDA. That is a metric that they use with their bankers when they're getting those loans. It is, they talk about this is the low end of where we've been, but the reality is interest rates are much higher now. And so saying, hey, we're at the low end of where we've been for decades doesn't really mean a lot when interest rates have moved significantly higher, and that's going to mean a reset for this business. And for example, they talk about how, look, the weighted average interest rate for our total outstanding debt was 3.1%. 95% of our debt is fixed. So they did a great job locking in a lot of this stuff, but a weighted average maturity of around 3.5 years. So they're going to have to swap this out, refinance their debt, their capital structure, which is significantly leveraged over the next few years. I don't think their first maturity is not for, a year or two, but still looking at it, it's a lot. When you're talking about a maturity, weighted average maturity of a couple of years out, that means within the next 5 years, you're going to see them do a lot of refinancing. And that interest expense can surge 50 to 100% higher potentially in the years ahead. It's a super important point because that is a very real expense for a business like SBA. Now, this is a REIT just like American Tower. So the goal is to pass along a lot of the free cash flow to shareholders. Right now, they're only passing along a fraction of their cash to shareholders via that 1.5% dividend. They also have, a buyback in place, but they're not really exercising it, partly because they recognize, hey, we got to pay down our debt. And you can see year to date, no share repurchases. They did some prior years, and you can see capital allocation by year, $2 billion, $1.5 billion. This is a company that historically spent a lot of money per year. Now, their free cash flow is close to $1 billion a year. So this meant they were taking on debt during these periods, to pay some dividend, around $300 million a year. Now it'll probably be closer to, $350, $400 million. But looking at it, this is a business where now they've said, oh, snap, we need to start repaying. We need to start, the amount of debt we have and the fact that interest rates have skyrocketed or jumped. They're not even skyrocketed relative to the, early 1980s. This is nothing. People would say, this is fantastic. And so there is a mental readjustment. That's why it keeps going back to this question of what is the right interest rate for corporate bonds when you can get around 5% on cash. And if that 5% on cash, and once again, see that link below for Interactive Brokers, where again, 4.8% plus, if you can get that by just parking your cash somewhere, is a 1% spread really worth it? Or do you need 2 or 3% above that? And when you start dealing with that, that's going to have a huge impact for a company that has so much debt. And they've used this debt, I think, intelligently historically, but the bill has come due, with higher interest rates. And it's coming due in the coming years as they have to refinance their debt. And some might say, well, Daniel, what about the cyclical concerns? And maybe, some of the carriers might be looking to spend less money and that their growth might not be as compelling in the years ahead. I don't think that's really the driver here. I think the structural thesis is still there. And the fact is they recently raised their outlook and guidance for the year. So for a stock to be down over the last 3 years, when you have a company that's arguably executing and raising their outlook, delivering on, what they're saying, when you have that type of situation, and here it is, you can see they raised their outlook on their adjusted EBITDA, they raised their, their estimate of free cash flow, their adjusted free cash flow, funds, raising their revenue, the leasing revenue that they're expecting, keeping their site development revenue flat. But looking at this, for the stock to be down despite a raised outlook means it's a broader macro concern, in my opinion. And that broader macro concern is, will rates stay higher for longer, and what impact will that have on a highly levered business? Stock currently trades around $216, around $24 billion market cap. They're guiding to growth that's similar to American Tower. You're talking about mid to low single digits, a little bit higher margins than American Tower, but they do have sizable interest expense, sizable amount of CapEx. It's not the same amount that they have for depreciation, But, looking at it, they're doing around $1 billion, $1.1 billion in free cash flow. So trading around 20 times free cash flow. Maybe it grows at high single digits in the future. Maybe it grows at low teens. I'm giving them a little bit greater credit for growth than American Tower, thinking about this business, because it's a very similar business. It's about, it's a smaller business, but very similar business model. Thinking about higher interest expense in the future, higher amount of CapEx in the future as they invest to grow, to get these growth rates. I'm effectively penciling out, a company where maybe over the next 5 years, you can get a teens to 20% type of annual return. Broadly, I do like this type of setup. I do like the setup when you're looking at a company and you can say, hey, I think, based on a hypothetical valuation framework, and of course, stock prices go way higher or way lower, depending on their execution, depending on sentiment. But broadly, I like looking at a setup like this where you have very stable free cash flows, very clear opportunity for growth. But I do have some reservations. And I don't think it would be part of my investment journey because of the customer concentration. That is real risk. Even though you might say, well, wait a second, they're never going to leave. I suspect that's right. It just gives me heartburn when 40% of your domestic sales come from one customer. Could that create issues in the future, unexpected issues in the future? So you have that aspect. And then I think the second key aspect is this debt, like I've mentioned, and having 6 times plus debt. When you're now in the cycle where you have to repay it, it is much harder to generate that growth because that interest expense is going to be increasing in the years ahead. And so I look at this and it's too hard for me. Wouldn't be surprised if it does work out for shareholders. You can pencil out 18s to maybe even a 20% return. I personally wouldn't buy it. Now, how come, how would you compare this versus American Tower? So a couple of different things. So one, this has more leverage than American Tower. This has, I would argue, comparable growth. It's a bit smaller, about a third the size or a quarter the size. So, maybe it can do a little bit better growth over time. But, so you're thinking about that aspect. It does trade at a little bit of a discount, very slight discount relative to American Tower, looking at their free cash flow. Does have higher margins, than American Tower. So overall, I'd say very comparable setup. Around 20 times free cash flow. American Tower is closer to 25 times. American Tower is 3 to 4 times bigger, going to grow slower. Here they're going to grow maybe a little bit faster because they're smaller. But I would rather, if I had to pick between American Tower and SBA, I would probably pick American Tower just because I like sleeping better at night and they have less leverage. And they also have less customer concentration. So you've lowered the risk of blow up from 2 different angles with American Tower versus SBA. SBA, you really do have much greater, you have greater blow up risks from those 2 angles. So I look at this and, you have this 1.5% dividend. I would expect that to continue to grow at a good clip in the years ahead, partly because it is, the dividend is only a fraction of their free cash flow. And so they'll be able to amp that up significantly in the future. And they do have continued growth opportunities in the future with either acquiring towers or building them out around the world. So I can definitely understand why investors still like it. And you have, many investors involved with things like American Tower and SBA. But I would personally rather find the founder-led businesses with clean balance sheets, net cash balance sheets that also have that growth opportunity, that also have significant free cash flow. And you can wait for things that do fit that, where you don't have that customer concentration. And so, I'm looking at my top holdings, for example, and, that's for the most part, that fits that profile of much cleaner versus what you have here, that it still might work out because of the financial engineering and the durability of the business model. But I would rather just, concentrate in things that make me feel a little bit more comfortable for my own investment journey. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button, and check out Unrivaled Investing. Thanks so much.